So, is gold a bad investment? Why do people say this? I think a lot of people say things that are negative about things that they don't understand. And so, we're going to talk about with all the money printing that's happening, with inflation, all the talk of things that why gold may not actually be a bad investment, but could actually be a phenomenal investment. So, to answer and to talk through this question, I have a friend of mine who's here, Brien Lundin, who hosts the New Orleans Investment Conference, where there's multiple asset classes. He also writes the Gold newsletter. Welcome, Brian. How are you today?
Great to be with you, Bronson, talking about one of my favorite subjects in the world.
Absolutely. Mine too, man. Mine too. So, is gold a bad investment? And why do people say that? Why do people say that gold may not be a good investment?
Well, it can be a bad investment, and it can be a good investment, and it can be a wonderful insurance policy, and it's really can be all those things. A lot of the people that say it's a bad investment, they prove that argument by comparing gold to whatever they're trying to promote at the time, whether it's stocks, bonds, cryptos, or whatever, and they pick a specific time period and they say gold dramatically underperformed this asset over the past whatever time period. And there's an old adage in the industry that, I can prove any trend if you let me pick the beginning and the end. So if you want to cherry pick those data points, you can really prove anything is better than the other. And it's really a mug's game. It doesn't, when anybody does that, I say, well, gold beats everything else over the last, except perhaps some of the cryptos here and there, but over the last 20, 10, 5, and 1 year, at some point you can make that argument for gold against even the highest flying stock indices. So generally speaking, in any investment class, you can say any specific asset class is a bad investment compared to something else. But gold really outperforms a lot of other investments when people are concerned about their underlying currency and its purchasing power and the future of that currency. It's not the best technically inflation hedge out there because it doesn't track the CPI step by step. If you want to track the CPI step by step, you could probably invest in energy, in oil, because it's the only asset class that's actually a component of the calculation of the inflation indices. But what happens with gold is when people aren't concerned about the future of the currency, it kind of languishes and goes sideways, sometimes for a number of years. But when people start to really get scared, then it makes up for lost time, and it can go nearly exponential, and or the investments that are associated with gold, like perhaps mining stocks and the like, can go exponential. So as an investment, its timing is important. And for the other reason to invest in gold as insurance, the timing is important. The best time to buy it is yesterday. and
Yeah.
if not, the second best is today. And everybody needs to own some for that.
Right. Right. No, a lot of people, it's interesting. As I didn't realize this over, except really the last couple of years, that gold and silver have a history of really being money for the last, for thousands of years. And even in the US, we actually, it was tied to gold. You actually could take a $20 bill in and go exchange it for a 1 ounce gold coin. And of course, then, when currency went from being a claim check on the money to actually, or from you'd actually take it in and get the money, which was the gold, to now the currency is the money. So there's been this sleight of hand that's kind of been done. And but can you talk a little bit about some of the history of fiat, the currency as well as gold, and kind of how those relate with each other?
Yeah, for convenience sake, even when the U.S. was on a gold standard, and in some cases a bimetallic standard, gold and silver were money at a set ratio set by the government. There was still paper money, but it was distributed by private banks, which then supposedly held an equivalent amount or close to equivalent amount of that paper money on deposit as gold and silver. So if you went to Standard Bank of Champaign, Illinois, or something like that, and you gave them one of their notes that they had distributed, you could get that much gold or silver in return. Now, if everybody went at the same time to do that, then the fallacy was exposed of what's called fractional banking, where those paper notes were only backed by a certain percentage, maybe 20, 30, maybe even as much as 50% in gold. But that's when they used to have bank runs, and people would turn in all their notes to a bank to get that bank's gold or silver holdings in return. And then the banks would shut down. You'd have bank holidays and the like. But throughout human history, whenever every civilization throughout human history, as you say, gold and silver have been around for millennia, 4 or 5,000 years as money. But governments throughout in civilizations throughout human history have always done the same thing, because human nature is the same as it's always been. When in power, they've always overspent. And, the Roman government had entitlements that would rival anything that we had these days. In particular, they wanted to keep the soldiers happy. So they had pensions and benefits, et cetera, et cetera. And of course, they had an empire. So they had, like the US military campaigns around the empire, around their known world. And they would overspend and run budget deficits. And, the term bread and circuses, to keep the people happy, they would put on a lot of public amusements and the like. So they would create these debts, and to pay for that, they would actually, even though they were on a gold and silver standard, they would debase the currency. They would actually take the silver coin, the denarius, and reduce the silver content by alloying it with other more common base metals. So we've actually been able to track that, the history of the devaluation of the Roman denarius. And, historians today, they look back at that and they say, well, this was the signal of the collapse of the Roman Empire. This was a default of that currency because, say, over 60 years, it lost 80% of its value. It just plummeted in value. Well, the US dollar's done that. People say it won't happen here. It's already happened here since the 1960s. For example, since we took silver out of our coinage, the US dollar has lost 88% of its purchasing power.
Wow.
So it's a trend. What I like to tell people is this is nothing new. People are the same as they've been over thousands of years. These fundamental characteristics of human behavior are the same as they've been for thousands of years. What we're seeing happening right now is really kind of the end game of a trend that's been in progress, or has happened before over and over again. With one key difference, the world's so interconnected now. And, previously, governments could debase or devalue their currency in one fell swoop and gain a short-term trading advantage with a cheaper currency, and try to rejuvenate their economies. But today, every developed economy out there is trying to do the same thing. They're trying to devalue their currencies as well, because these debts have once again grown to such enormous and unmanageable levels. So every country out there is trying to devalue their currency. They're all racing to the bottom of the hill together. So if they're all devaluing, then what can they devalue against? Well,
it's interesting. I just want to stop you for one sec. That's a really interesting concept, because we've never really had a time like this before, right? Where all the countries of the world are devaluing their currency at the same time. And it's, our friend Russell Gray likes to talk about it. It's difficult to think outside of a currency, right? We just think of like, oh, I'm going to invest in whatever this thing is, whether it's gold or real estate, other things. And then all of a sudden I'm going to sell it for all this many dollars. Well, the dollars in the last 18 months, I've heard it's somewhere around 40% more currency is in existence than there was before. Of course, we don't know exactly what that is, but it's substantially more. And then, of course, all these trillions of dollars spending bills they're presenting, which sounds like they may pass this and that. We just did an event recently, actually, with Rick Rule and Jason Hartman, called the Endgame. It's on YouTube as well. But what do you see some of the, like, what is the solution for governments in this situation? Because a lot of times to me, it seems like they just kind of print more to cover the debts they already have, and it gets to kind of be like, it kind of spirals even more, like even faster. Is that kind of what you see as well?
Yeah, I don't know whether we're in the end game, or whether we're going to have a few more cycles of this, but the trend is pretty obvious. If you go back, and I do this in a lot of my presentations, I go back to the early 1980s, right after Volcker killed inflation, and that's another whole thing. We don't have another Volcker around here anymore to rate
Yeah.
interest rates. But if you look at that, and you can get this chart from the Federal Reserve, you can download it, look at the data yourself. But if you look at the effective funds rate for the Federal Reserve over those decades, you can see a step-by-step process ever lower. And whenever there's been any kind of a hiccup or even a recession in the economy, the prescription has always been the same. The central bank has lowered rates lower than they were before. And then when they've tried to normalize rates, they can never get it back to even the midpoint of the range it was at before. So it's step by step by step, ever lower over 30, 40 years. And then you get to 2008 and they hit, they step down from the first floor to the basement or to the foundation. They hit zero interest rates. Try to normalize it, got it up to 2.5% on the Fed funds rate, and then had to go right back down post-COVID. So, at this point, they're going to have to open the door and go into the basement if they're going to continue this trend and go to actual nominally negative interest rates, which they say they won't do. But, who knows? That's the trend. So whether this is the end game, I don't know. But every time you go through this cycle, the currency loses some credibility, and we're taking it to, unprecedented levels right now.
Yeah, no, it makes sense. And with all this printing, it is very interesting to watch. And the last few years of those, people that have been watching gold prices, sometimes it can be a little baffling because here we're printing all this money. And at least over the last few months, last 6 months, whatever, gold was close to around $2,000 an ounce at the time of this. I think it's around 1750, probably not somewhere in there. But so why has gold come down a little bit, and why does it have some fluctuations, even though the currency is increasing? Because you'd think more currency would buy you less gold, so therefore the value of gold should rise right away. But why does that sometimes lag, or does it not directly show up?
Yeah, it isn't a one-for-one relationship, as I mentioned before. It's a barometer, really, of people's concerns. So a couple of things. We had, right after post-COVID, we had that big liquidity crunch, and the gold price dropped over a couple of days, and then it bounced right back up. Back after 2008, that was a process that took 4 or 5 months to where it would drop, and then the policy prescriptions came in from the Federal Reserve, and it started soaring as people kind of recognized what the Fed was doing. This time it played out in 4 to 5 days. So that's one thing. Everything's happening much more quickly. And over the course of, say, mid-March through the following August, the price of gold went up 30%. Since then, we've retraced about a third to half of that big gain over a kind of a long-standing correction. But that's really not, in the long history of gold, that's not that extraordinary of a correction after a run like that. So that's one thing to look at. And the other thing is, gold is a predictive instrument. It's looking forward. It predicted in that 30% run all of the quantitative easing and then perhaps the fiscal spending. Right now, gold is uncertain, I guess, as to what level of fiscal response we're going to get out of Congress. Hell, everybody's uncertain about that. So it's understandable from that standpoint whether that the message is a bit muddled. The other thing is, what's going to happen with the Fed? Will they be able to tighten? And I think gold's reaction to that is going to be a bit less predictive and more immediate. When we all find out that the Fed can't raise rates, when we all find out that they can't even taper without cratering or get very far down tapering without cratering the stock market and really this financial house of cards that they built. When we find out about it, gold's going to know about it not much longer before then. And we're going to see a really dramatic response in gold. So I think we're going to have a turnaround. But then again, the fact that everything is so uncertain and really pivotal going forward, I think is an argument for the insurance aspect of gold and silver, that what you're doing is protecting your wealth against the inevitable further depreciation of the underlying currency.
Yeah, absolutely. A lot of people wonder, I think for a lot of people that have been around for a while and have seen a lot of these cycles, kind of lived through the late 70s, early 80s, high inflation, the conversation's much more familiar. But for most people that are younger, or just maybe they started investing in the last 30, 40 years, we really don't know what high inflation looks like. And I think for anybody watching or listening, I think it's really important that you think about getting some gold or silver, getting started in it because, and physical, not just, ETFs, because it really is something that you can have outside of the financial system. And if things start going really sideways, to have some wealth that you have a store of value that you don't have to necessarily rely on dollars that may be worth way less, or have some illiquid investment like real estate, it really does provide insurance. And I think it really provides liquidity that you can actually spend pretty quickly if you needed to. So I think it's really great. But let's talk for a minute about that. Why would you say, Brian, that physical metals are better than ETFs?
Well, not necessarily better. It depends on what your goals are. But I would say they're necessary. If you have any significant wealth built up, then you want to protect that with the insurance of gold and silver physically in your possession, some degree of it. Now, for people who have a lot of wealth, then it becomes really a logistical challenge to have, say, 5 to 10% of that wealth in physical metals within their accessible to them, near access. And then you may be able to hedge it through some ETFs and things like that. But everybody needs to have some physical metals because you're hedging against something. Well, number one, it's insurance against something you know is going to happen. You don't think your house is going to catch on fire, but you insure against it. You know that the dollar is going to depreciate at some degree of speed, or whether it's going to be fast like the 1970s again, or whether it's going to be like the 1990s at a slow pace. It's still depreciating every day. So you're insuring against that inevitability by owning gold and silver. You want to have some in your physical possession because you're also insuring against some collapse in the financial system. And I'm not one of these people that say, oh, it's all going to hell in a handbasket, buy gold, silver, and copper jacketed lead tomorrow and everything else. I do advise that, but I don't advise that it's a necessity that's going to happen. But you want to be prepared for just about anything. So having these metals in your possession means if your bank shuts down, has a bank holiday, if you can't get in the bank, you can't get in your safe deposit box to get your metals. So you want to have it in your possession somehow, safely, securely, and without it being known to an awful lot of people. So yeah, first thing I tell people is when they're looking at investing in gold and silver, find a good coin dealer, check prices, get some physical bullion in your possession, figure out how to store it safely. And then you can look into more liquid options like the ETFs, the Sprott physical bullion trusts for gold, silver, platinum, palladium, even uranium now are great ways to invest on the ETFs. They're actually the only ones I do recommend. And then you can get more metal exposure through those. And then there are ways to leverage those investments as well.
Yeah, I think I like what you said because, yeah, there are times where, for sure, when maybe people will put money into an ETF. I think I have a Roth IRA, and it just makes sense to put some into one of the Sprott silver or gold, funds, and makes some sense. But having some access to physical metals is really important. So, are there any disadvantages of owning physical metals? I mean, obviously, theft or something like that is a disadvantage. But are there some disadvantages you can see of owning physical?
Yeah, I mean, it's just the bulk. Gold stores more value per volume than silver does, but silver is more divisible. You can get what's called junk silver or bag silver in the coin collecting community, which are just old silver coins, U.S. silver coins. They're great because they go down to dime size. So if you ever get into a situation where you actually have to spend your bullion holdings to buy stuff, you can, obviously they're more divisible and you can buy little things with those silver coins. So I tell people they should have a little bit of both. The monetary metals really primarily are are gold and silver. Platinum and palladium are precious metals, but they're more industrial in usage and not so much recognized as money. So, those I think are more investments and not monetary insurance. So those are the disadvantages. Storing them, doing what's called midnight gardening, where you bury them in your backyard, that can be a disadvantage, of course. There are ways to hide and secure them in your house outside of safes, and you can download reports on the internet on great ways to store valuables unbeknownst to others in your home. But every thief and burglar worth their salt has already downloaded those reports, so you need to be aware of that as well. Yeah, there are definitely disadvantages, but it's something that, at least until you get into very large quantities, can be done safely and securely in your home.
Right. Going back to that question we first asked, is gold a bad investment? It's interesting that gold it has many different purposes, right? It can be actually where you store wealth, so it's a store of value. It is an insurance. It is an investment. People can invest in it, thinking I want to buy it at this and sell it at this, or speculate in it. But like one question people ask, and of course we can't tell you, Brian. I can't tell you this because we're not your investment advisor. So obviously seek your own, CPA or your own advice from an investment advisor. But what sort of like percentage of net worth do you see that people allocate to metals?
Yeah, that's tough to say. It really is. And again, I'm not a registered investment advisor, so I can't advise anybody that closely on what fits their, or at all on what fits their individual circumstances. There have been studies in modern portfolio theories saying that 5 to 10% invested in gold maximizes your risk-adjusted return in a portfolio. But a lot of that kind of stuff has been invalidated by the fact that every asset class has been driven higher over the past 15 years or so by monetary policy, and just all this free money that's being dispensed with no real place to go, that everything, bonds, stocks, real estate, precious metals, everything has been driven higher, floating on top of these oceans of liquidity. So there aren't as many correlations or anti-correlations out there among, there's not that much that you can get contracyclical from one asset class to the other. They're all being floated higher. So generally speaking, 5, 10, 15%. If you're looking to leverage it, then you can also look at that as part of your metals holdings, not a replacement for some fashion in physical metals. But mining stocks, for example, the big gold mining stocks might go up 4 or 5 times during a secular bull market in precious metals. The junior mining stocks could go up, many of them can go up 10 or 20 times or more in value in that kind of a bull market environment. So that's something to look at as well. I have a report on my website called the Investor's Guide to Gold and Silver. That's a free report that kind of examines all of that, the different ways to hold the metals and the leveraged ways to play them as investments as well.
Yeah, I know there's a lot of ways to get involved with it. I also think it's one thing I really appreciate about you, Brian, is that you look at things really as, not just what is the investment, but what will it do for you in light of monetary policy? Because at the end of the day, like, my background is real estate, but, real estate is not that, special except for what it does, the returns or the inflation hedge or the other kind of qualities that it has. And I think that that's why gold and silver is just, it really, I think it's very, very compelling because the history of, how it's been invested in. And I know you're interested in a lot of these other classes. You mentioned uranium. I know your event is coming up. You've got this incredible event that's been going for 49 years, the New Orleans Investment Conference. Can you talk a little bit about what attendees can expect? And I'm planning to be, I know you're going to be directing that and hosting that, but if someone comes to that event, what can they expect?
Well, they can expect really an intellectual energy and ambiance that they'll rarely find anywhere else. It was started in 1974 by my late business partner and mentor, Jim Blanchard, who lobbied in the early 70s to get the right of gold ownership returned to American citizens. People don't realize it was illegal to own gold, if you can imagine that back then. So he did a lot of crazy stuff to get that reversed and the law passed to allow people to own gold, which happened in late 1974. So he decided to have an investment conference to teach people, teach Americans how to invest in gold, which he did, and he kept doing it. And he was pretty over the top in a lot of ways. So he had just got some incredible speakers to come speak over the decades. I mean, we had Ayn Rand had her last public presentation at our event. We had Margaret Thatcher, Milton Friedman, Barry Goldwater,
Wow.
Alan Greenspan, really hundreds of the top thought leaders of modern history have graced our stage over the decades. So it's always been a special event. And since Jim passed in 1999, I've kind of been tasked in carrying on that grand tradition and getting those big name speakers down to New Orleans. So it's been quite an act to follow, as it were. But this year, because things have been so, because we're at really such a crucial time, I've gone out and gotten my wish list of speakers, dream team of experts. So we've got Dr. Ron Paul, we've got James Grant, we've got Jim Rickards, Danielle DiMartino Booth, Jim Urio, Doug Casey, John Najarian, Rick Rule, Peter Schiff, Dave Collum, Grant Williams, Dominic Frisby, Tabby Costa, Lawrence Lepard, George Gammon, Brent Johnson, Peter Bookvar. We've got the real estate guys coming, of course, our great friends, and other speakers focused on real estate. So it's just, the list goes on, dozens of people coming in. Being an in-person event, we are going to have a virtual option so you can get the content without having to come. But being in person is just nothing like it. The air practically crackles with the intellectual energy of being amongst so many people who are very entrepreneurial, smart, successful, and analyzing what's going on in the economy and the markets, and really sharing the best ideas. The value is as great amongst the fellow attendees as what you get from the podium of the event. So I'm really excited to get back in person.
I'm excited too. I've been loving in-person events. I have not been to the New Orleans Investment Conference. I'm going this year. So if anybody's listening or watching, I will be there. We can connect while we're there. But there's something about being around other people that are really pursuing the same things. There's a real collaborative stuff that happens. And, you get around other investors that no one's trying to sell you anything. They're just simply trying to learn. And here's what I learned. And it's just amazing the things that you can pick up. So see you there at that, Brien. I know you're also going to be at the 4-day defensive handgun training in the Vegas area. So I'll be there with some of my crew as well. So if somebody's interested in joining, that's going to be I believe it's October 12th through the 15th, and it's a phenomenal training. So there's some info about that. You can reach out to us for that. But what's a way that people can get in touch with you? You mentioned that free report. Can you share with people your website and how people can reach out to you?
Yeah, neworleansconference.com, very simply, for information about the conference, and or goldnewsletter.com to learn more about Gold Newsletter. And you can find out about either one at either site. So
awesome, Brien. Well, I want to really just commend you for coming. I've always appreciated your just deep knowledge of economics, speaking not just about metals, but about all different aspects of it, and the way that you network well with people, and you really desire to add value to everybody you speak with. So really thank you for that, and really great having you on here today.
Always a pleasure, Bronson. Look forward to doing it again sometime, and always a fun discussion. Thank you so much.
Okay, so this interview talking about is gold a bad investment is really important for people just to look at, because a lot of times when we don't understand something, our minds can just say, well, I don't do that. I don't do crypto. For me, it's been hard with crypto, right? I've been looking at crypto because I'm like, I don't know if I really like it. I don't understand it, but it's changing a lot of technology. It's changing a lot of the way that we invest, and the blockchain coming into real estate. I've got a really exciting episode I just recorded coming out about that, about blockchain and real estate. You have to pay attention for that. But Brien is he's a very well-balanced guy when it comes to looking at investments as a whole, right? So it doesn't matter what the investment is, it doesn't matter what the asset class is, it matters what it does for you and the different elements that it has. And right now, with massive government spending and printing, it's so important that you have quite a bit of money in assets, things that will hold pace with inflation, things where there's some hedge there, and things that store value. So to me, I use gold for insurance in case inflation picks up a lot or fear gets through the roof. Right now, people aren't really afraid of a lot of stuff, but if that happens, having some metals can be very helpful. I also use it for liquidity, meaning instead of just storing in cash, if you have stuff in gold, it can be sold quickly. You can actually borrow against it if it's stored in a certain vault. There's a number of vaults that do that as a service. So anyway, thanks for taking the time to educate yourself, and we'll look forward to seeing you on the next one.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.